Hi, everyone. Welcome to another market talk. So good to be back. I was away for some time, and of course, as always, we had interesting 2 weeks. And of course, what a surprise! Everything is still bullish. Volatility is very low, and bears are not happy. So I'm sure we have a lot to talk about. And yeah, so Bryan, let's start from you. So how's it going? What you see in the markets and what are you doing?
Sure. Yeah, let me share my screen here so we can get down to business. Just loading it 1 second. All right. Looks like MFR is having some trouble there, so let me just go to my signals instead. Everything's running a little slow, so I'll give an overview while things get popped up here. In general, it's been brutal the last couple of weeks for sure. Initially through May, my biggest mistake was letting the high beta, low beta spreads get too long in the neck. That one really took off and squeezed a lot of bears. They were selling defensives a lot through May, which didn't work out really well. And that one, I wasn't able to catch that one. So for example, if we look at something like XLV over QQQ, this is a spread that I started watching a lot more. We saw like throughout the course of May, which is when I was really trying to start shorting, they started selling defensives versus growth very early on. XLV over QQQ, XLP over QQQ. These got hit very hard. So like low beta underperformed significantly throughout the entire course of May. It wasn't towards around like the back half that they really took that selling from early May and ran with it in terms of a major outbid and move higher for high beta, which was the main catalyst for the recent squeeze. So that was one of my bigger problems. That softened sector correlations. Additionally, stock bond correlation remained very negative throughout the course of May. And one thing I kind of learned from that whole event is looking at the correlation not only from being supportive from that perspective, where if bonds and stocks aren't going down together, then broadly risk isn't that high, and 60-40 portfolios are performing, and it's not that big of a deal broadly for risk. But instead, what I've started to look at too is reaction to news, and so reaction to macro overall. So if you have a negative stock bond correlation, which broadly percolated throughout the course of May, that means that good news is good news, essentially. So if growth remains high and labor market remains well supported and ISM reports don't come out that bad, then you get a consistent sell in bonds, which is higher rate hike expectations throughout the course of the year and for the future. And then that correlated then to a bid for stocks. And so that's really how it kind of turned out. Obviously earlier in the year and then last year when stock bond correlation was positive, hot inflation data, hot growth data was bearish for the markets. But through May, that wasn't really the case. And I did have the thesis that, we weren't in recession, where we were far from it in May, to where that data would continue coming out hot, especially on labor reports. And that didn't really put two and two together. And so that's what really caught me off sides on a lot of shorts. And then that coupled with the fact that they were really selling defensives, and they weren't selling defensives to go into dollar, for example, they were selling defensives to buy AI and high beta tech. And so what this has done now, I'm going to log out here and try to log back into MFR just because I had a watch list set up here that was going pretty well. So just give me a moment here. One second. All right, it's got pulled up. Okay. So this weekend, I kind of flipped the script in terms of some of the stuff I was looking at. Before I was, kind of in the inflation camp, and that Fed hawkishness was really what was going to drive a potential sell in markets. But now where I'm at is actually the fact that bad macro data and growth slowing and us potentially pricing a hard landing or recession is what's needed to crash markets at this point. And so we've seen early cracks on Friday's NFP report. It wasn't the strongest thing in the whole world. Monday's ISM services wasn't the strongest thing in the whole world. That one actually ticked down slightly. If we look over here at ISM services, new orders ticked down to one of the lowest levels this year. ISM, that's manufacturing services right here, still ticked down to the lowest level this year, lowest level since December. ISM services employment ticked down, ISM services prices ticked down. So all of that did show some softness.
Hey Bryan, sorry to interrupt. I think you're still on the MFR screen.
Okay, thank you, Robby. Let me fix this screen share here. Sorry for the technical difficulties. Let's see here. All right. How's that?
This is the there's
great. Yeah, so we did see some softness in those reports. So ISM services new orders down, services employment down, services prices down. And then so that in conjunction with this heavy sell that we've seen for things like selling low beta versus high beta, selling healthcare stocks versus Qs, selling staples versus Qs. We're at the point now where a lot of these spreads within my fractal range are what we call capped to the downside. So that's where the near-term range and the long-term range equal each other. And so that tells me that there's just no more runway to the downside right now for defensives to be sold versus Qs. And we see the same thing. This actually happened at the last weekly talk we had. And it's kind of chopped since then, though tried to go higher, but high beta, low beta is capped to the upside. Additionally, what I have also is SHY, which is obviously 2-year bonds, as well as the 2-year yield themselves is capped to the upside. So there's no more room. What these are telling me with these defensives being sold versus oversold versus growth, 2-year yields getting capped to the upside, 2-year bonds capped to the downside. Gold was capped to the downside. This has opened up a little bit, but broadly the long-term range is skewed higher. IWM over QQQ, though a lot of hedge funds just got wrecked on that spread yesterday and it snapped back today, the signal in MFR is very poor. There's not much excess long-term upside, and that one is still a bearish trend. So what these are telling me is that what we actually need to look for is some kind of deflationary risk-off event. That's the bottom line. And additionally, today we got a cap to the upside on QQQ. We got a cap to the upside as well on XLK. If I can take my word for it, it happened today, just like Qs. There we go, XLK, cap to the upside. So all of these bullish trends that have been in play actually since October, and this, you want to call it a bull market, have largely exhausted. And I think this most recent capitulatory move in May, where all of the prior recessionary bears going all the way back from when they put these positions on in December, we remember in December, we got a very similar move on high beta, low beta. Everyone was pricing in the potential for recession here. They got overextended. High beta, low beta ripped to start the year. And then we got to the point where stock bond correlation was positive. They sold in March. Stock bond correlation flipped negative in March. We weren't in recession. And then now May, we got the squeeze back on high beta, low beta again. And confluence with the fact that we're capped to the upside in MFR, we're also capped. We also have these sell signals from Raphael and his tool. And so those work well together. So we got this signal the signal came at the last meeting, which was the 25th, around about there. So it has ticked a little higher since then, but it's broadly exhausted with all defensive versus growth spreads too. So I was going into this morning's claims with the expectation that we would begin to trade some kind of deflationary risk off event. And like, I'm not in the weeds on the macro. Like, I'm not watching what claims are saying, like where claims are trending, unemployment benefits, all of that, labor report. Like, I'm not really in that. But I got these signals, and then this morning we got a spike in jobless claims. So something is going on here with, I think that we're going to have some kind of event. Now, this could just be a bear talking after he's gotten squeezed for a month, talking for some kind of event to crash the markets. But like, I wouldn't be saying a deflationary risk off event when I've been a bond bear and an inflation bull for most of this year, unless I was getting these signals. And so that's kind of where I'm at. You know, stock bond correlation is negative. It's not going positive. It's broadly stayed negative throughout the course of the post SVB time. They've oversold defensives, and oil is positively correlated with stocks, for example. Weakened a little bit today. Gold is negatively correlated with stocks. Gold miners are negatively correlated with stocks. And so, yeah, so I think the risk right now is for something like that. And what that would look like would be Russell leading lower, which Russell responded properly to the jobless claims spike today. But SPYs and Qs had their own opinion. And it looks like now, so TLT gets dumped yesterday and they sell Qs. TLT gets bid today, they buy Qs, but TLT has broadly been selling throughout the course of May, but they're still buying Qs. It doesn't make any sense. All I know right now is that now Qs are capped to the upside. So tech broadly is overextending in its bullish trend. Vol is at a complete floor, and they've oversold defensives versus growth. So people are completely off sides for no recession right now. So the right now, like the bulls aren't even in the camp for inflation staying hot, because inflation staying hot, it actually might be a bullish thing because that means growth is good. And so if inflation accelerates on the CPI report, I actually would think that maybe the market thinks that's going to be bullish, because that means growth has been broadly perfectly fine. So I don't know how that works with going into the Fed meeting. All I know is that bonds are probably a long right now. I don't want to long them, especially not on the longer duration, just because the Fed isn't there to cut yet. I think it would take something really significant beyond what we saw in March for the Fed to start cutting. So I don't want to long bonds. And that also makes me not want to long gold. I'm not short them anymore, though I've covered them. I'm still long dollar, but I'm shorting all of these stocks. So high beta cyclicals, I'm shorting them. Russell components, I'm shorting them. High beta tech that's capped to the upside, shorting that. I actually started shorting energy too. We'll see how that works out for me, given the correlation between SPYs and oil. And energy is a really poor performer in deflation. So we'll see how that goes. And yeah, that's where I'm at. Any last points beyond that? Oh, last point, credit spreads. So if you look like LQDH, the poor man's, investment grade credit spreads, that one's kind of been stabilizing here. Momentum starting to turn lower on it, both on Vi's score as well as Raphael's signal here. And so, yeah, and like also like on that, if I think high beta, low beta is going to roll, and I think XLU IWM is going to continue bouncing, and I think XLV over QQQ is going to continue bouncing, which I'm long both XLU IWM and XLV over QQQ here. The reason I think that's bearish is just because of the correlation. So high beta, low beta is broadly correlated to SPYs, positively correlated. XLU IWM is negatively correlated. And so if those continue what we saw today, which the reaction was actually fair and proper today to that jobless claims number. So those have high Hursts. I think that those continue higher from their downside caps with a lot of runway within their long-term ranges here. But if we kind of skew this little deflation watch list I got going here, we skew that like long-term upside downside ratios are very good. They were at like 3 to 4 when we were at the lows earlier this week. And so, yeah, everything's telling me that we're about to start pricing a significant growth slowdown that'll be expressed via deflationary risk off. And so that's what I'm looking for. And that's all I got.
Interesting. Yeah, okay, so let's continue maybe with Andrea. So Andrea, nice to meet you. I think it's our first time.
Yeah, it's our first time we can meet and speak. So, well, guys, a pleasure to be back.
Pleasure to have you.
Okay, so I have something to show, actually. So, okay, can you see my little PDF, right? Okay, should be okay. So I started writing this thing daily, where I pretty much discuss what I'm seeing in markets. First of all, for me, this year has not been great. I had a decent month in May. I was pretty much short rates, shorting bonds, and especially the short end in US and Europe, as I thought that the pricing was a little bit off. We had also last week, last week, some decent movements, but especially this week with the movements from the RBA in Australia hiking rates, and also the Bank of Canada yesterday acting on pretty much what say sticky inflation. They don't like the possible outcome of inflation staying above 2%. So yesterday to me was a day to size down exposures. We have seen pretty much, I would say that we have seen the bottom for pretty much bonds for the probably next couple of weeks, as the upside right now, even if you check in my fractal range, is decent. I'd say that in general, I realize that nowadays the movements in rates, they tend to happen before the Fed and ECB, why we tend to mean revert when we approach the Fed and ECB, because I don't know, everyone is scared of the hiking cycle or whatever, so they tend to reverse. What I was regarding unemployment, it's really interesting to monitor the unemployment benefits. So basically, if you go to the daily treasury statement every day, you can check how many unemployment benefits got paid from the TGA actually. So, and I've been noticing that, for instance, last week there was a tick up. This week, as of today, we are ticking higher. So definitely something is happening under the hood. I don't think it's something really seriously. I'm saying this because I still see fiscal impulse running really strong. At the end, with higher rates and people that have, like, if you check the net wealth, they are in the 96th percentile historically. So they are receiving actually fiscal transfers with these higher rates. It's a sort of MMT kind of argument, but it makes decent sense for me. And what I expect is also that the fiscal input store turn higher, and pretty much the government has to, let's say, take over what pretty much banks are not willing to do, because we have been monitoring credit since the debacle of the regional banks happened. And while at the beginning it looked like was something not really like didn't have a big issue on lending, actually now I'm starting to see that, for instance, real estate is literally cratering. I think shorting real estate related names can be interesting, although I'm not really into stocks. But still, I think growth can held up if the government is able to fill the gap. Let's put it in this way. And this brings me to my, let's say, second point, which is I was checking today probability recession from Bloomberg. For instance, they say that in 1 year we are going to have a recession, 100% is given. While checking my numbers, it looks like that Q1 24, Q4 23 is more like the outcome, like the time where it should happen. This to me tells a lot about what the market is actually pricing, because as Bryan said, we are seeing that at the end, when bullish report like on the ISM comes out, pretty much is okay. The economy is strong. We can keep at risk. It's fine. We buy stocks, we sell bonds. we don't really care, and we can keep going in this way. And I tend to agree. I'm starting to see the market reacting like it's kind of nervous, even the reaction to the initial claims, which, by the way, if you check the non-seasonally adjusted, it ticked up only by 11K. It's not that a big deal, but still, it's kind of nervous. It feels like everyone wants to be left behind, so they chase the movement, and I think it can be a really good market for mean reversion. On the other hand, the big topic probably no more, but still inflation is. I've been checking the nowcast of the Cleveland Fed just to have an idea, and I mean we have progress. I keep saying that inflation is sticky because we have all macro conditions to have inflation remain sticky for the foreseeable future. Actually, the regime that I have is saying that we are pretty much a regime 0. So, a regime 3, where we have a positive expected value on average, like a 20 basis point increase month over month with low volatility. So, I mean, I think you have the big pivot change by the Fed. Either you have a big spike in unemployment, which you can track with unemployment benefits, or you need to see this shift in the inflation regime, which for now is not. And even if you look, for instance, I do a PCA decomposition of the different curve for the inflation swaps. The market is pretty much saying that it doesn't care about short term. Over the short term, about inflation is everything about growth. But for the longer term, they still see pressures. So that's why I think bonds are not out of the woods yet. I don't think it's still the right time to buy bonds. You have negative carry. To me, it doesn't make any sense currently. I prefer much more the short term. In terms of inflation, the last time I showed the AQR inflation indicator, I'm tracking is literally collapsing nowadays. I built a proxy for Invesco. If everyone wants, I can share the links on how to build these indicators, but pretty much telling you that nobody cares about inflation anymore. But still, as the IM report said, we are still at level and whatever. But for next week, for the FOMC, I just say that it's the path is, for me, is just simply a no hike. It will matter a lot what they say, especially for guidance. I think they will try to sound a little bit hawkish, saying maybe we will raise if the data confirms that we need to raise more. And the market will tend to react a lot on macro data, and we have to be careful about maybe being positioned on the wrong side when those macro data come out. So I've been building some tactical asset allocation for where I work. So pretty much I think the key point is that you want to be overweight cash. At the end, receiving 5%. I mean, guys, it's I wrote it even in my blog. If I had, okay, I need to work for a fund, I need to generate alpha and whatever, but with these rates, it doesn't make any sense to stay in front of the screen, and it's better to go to the beach and enjoy the sun of Portugal. I have to be honest, it's much better. But for more like the kind of stuff I do, which is mostly rates, I keep saying that, well, cash, best allocation. But I think there is a lot of interesting stuff you can do on a relative basis. This is kind of what I do on a daily basis. I try to see which bonds maybe you can pair one against each other, or if there is any curve trade you can make. I've been trading pretty much the flattening in the 2.5 in Germany, the flattening in the 210 in the US, and especially the steepening in the software curve, which was a big win for me. That was a decent trade. But just to give an overview, a simple overview, I tend to use a lot of factors in fixed income. Mainly, you can use momentum. Simply, you can think about the 12-month momentum or moving average crossovers. You can use whatever you want. Then the carry, of course, is just the simple 210 curve, and you can think about it as just simple the yield you can get from the bonds. Usually you take like the 10-year and you subtract long-term inflation expectations or inflation swaps for the same for the maturity. Of course, you need to match the two. And quality is just realized volatility. And then what I simply build the weights are optimized with cross validation and so on. And pretty much this is the cross-sectional score that you get. And I have a couple of trades that I've been doing. The first one is long BTPs against yields, because I think, first of all, it's interesting that UK was the only one that had a positive PMI report. And it's can say quite a lot about how the situation in the UK can be messy, because they have wage growth, they have everything. And kind of the BOE it's really screwed. I think those guys, they really need to come up with something, because the bond market can get hit a second time. On the other hand, BTP are simply, they have great real yield. The curve is actually positive sloped. So simply, it's, for me, a no-brainer. That's performing. So it's good to go. Also, the treasuries against Canadian bonds is quite interesting. Yesterday, did a really nice move on the Bank of Canada hiking rates, because I think that this kind of behavior of, like, the RBA and the Bank of Canada, they tend to be a little bit more ahead of the curve, because the Bank of Canada went on pause early. So it's kind of a lead-lagging relationship. I think it's interesting to trade. Why Europe? Since I'm short the Euro stocks, I need to match in some way a risk composition, and you can express that as OAT, which are French bonds against bonds. And despite the GGBs have a positive score, I don't really like GGBs, because I still think that the BJ can be the nightmare of every bond trader. So the situation in Japan is improving, because if you read the comment in the PMIs, you can see some kind of positive outlook. But still, we can clearly see how simply growth is going higher. Inflation is okay, moderating, but still we are trending higher. So there is no reason to hold bonds. And of course, in my let's say sheet that I track to check factors and so on, the Nikkei was one of the best equity markets in September, and it has been bombing for quite a while. But yesterday I started seeing some macro gurus saying that the Nikkei is the best choice. So I have to admit that probably it's time to get out. So that's quite interesting. Also, Europe is the place where I struggle quite a lot, because I think they have been overpricing growth. And yeah, well, we can see that the ECB has still a lot of work to do, like wage growth ticking higher, with today data coming out pretty strong. And also, it's interesting to see how, even in terms of Z-score or cyclical and against defensive, we have kind of peaked in February and March, and then it was like completely wrecked. And to me, that was the time to get out of from European equities. On the equity side, I can add that I've been playing the S&P against the Euro stocks, as everyone was super bullish on Europe, but the economic data simply were disappointing. I still think that they have been overpricing growth for most of the European countries, especially core countries like Germany. But I think it needs to be some kind of mean reversion. I have been playing that, and you can play easily with ETF like the SPY against the VGK if you are interested. And so that's pretty much what I think about markets. It has been really tough in my opinion, because we see kind of very fast reaction. Nobody has a clear idea. Everyone wants to the top and the bottom. So it tends to be, it's kind of hard. We have these frenetic moves that do not really make sense. So you have to be good at timing and sizing accordingly. So yeah, that's what I have. And well, thank you for your time.
Yeah, good point on beaches in Portugal, because yeah, definitely this market, especially when bills pay 5%, and especially for those whose the US dollar is the home currency, I mean, it's a no-brainer, totally no-brainer. Okay, Robby, so what you see in the markets?
Thanks, Fi. I'll share my screen. So what you can see this ratios page.
Yes.
So this is just a page of risk on to risk off ratios, and it's just giving you a bit of a timeline from basically the start of the year to now. And the main point with all of these risk on, risk off spreads, so always the numerator is always the risk on asset. Hey, can you hear me?
We can hear you. Yes.
Oh, okay. I think my Zoom crashed accidentally. And it's telling me it crashed again, so hopefully it doesn't quit. But yeah, so the main point with all of these charts is that they're making new highs. So risk on assets to risk off assets are all making new highs across the board, except for, like QQQ to like IWM, because that was a big reversal this week. But apart from that, across the board, all of these ratios, most of them are SPY to like consumer staples, SPY to gold, SPY to longer term bonds, Qs to SPY. All of those ratios are all making new highs. So there's no, in terms of these basis ratio spreads, there's no cracks yet. In the period from March to sort of the middle of May, that was all pretty questionable in terms of risk on to risk off period. But since the middle of May, they've all broken out. I think what you'll want to see for a risk off period is basically these start to roll over and break their moving averages. In terms of correlation, there's not really a lot to talk about. Just across the correlation surface, you've got sort of low to neutral correlations. And the period from 2022, where we had red across the board, is now starting to roll off, because we've really not done all that much in the past, say, 3 months. There's been no huge directional moves. And then there's been slight shocks, which have prevented ultra low correlation. But apart from that, nothing is really going on there amongst sectors. The last one I wanted to talk about was volatility. So people may have noticed that the vol ETPs are getting really crushed lately. And Vi was talking about that just before the call started, and he can elaborate further on that. But basically the spread between volatility. Futures is quite high right now. If you take the ratio between VIX and VXV, you've got a 0.81 ratio. So that's basically the second decile. And in terms of forward realized volatility on the S&P 500 over the past 15 years, and what looks like is playing out now is the first decile, you've got, say, a realized volatility of 12% on average. The second decile, 13.51. The third decile, 15.28, 15.63, so on and so forth. The seventh, 19.6, eighth, 23, ninth, 25. And when you backwardate, that's when you get really volatile. You get an average volatility of 42.25%. But the main takeaway from this, which is kind of confirming what the risk on, risk off spreads are saying, is that for now, you should continue to expect fairly low realized volatility. I think what we're realizing right now is about 11% on a 21-day basis. And this is saying you should be realizing about 13.5%. So far, no cracks here either. The one thing I did want to say is that this situation where you're in a deep contango state can revert fairly quickly. And a really good example of that is in 2018.
Hey, Robby,
Hey.
are you showing something besides the sector correlations right now?
Oh, shoot, yes. Let's see, new share. Okay, can you see this heat map?
Yep, now we can.
Yep.
Okay, so this heat map is showing the deciles of the ratio of VIX, the 1 month volatility index, to VXV, the 3 month volatility index. And all I was mentioning is that the lower the decile you have on this heat map, the lower the realized volatility on average. So in this decile, second decile, where we're at 0.81 to 0.84, you can expect to realize about 13.5% over the next 21 trading days. Right now, the historical realized volatility is about 11%. So all I was saying is there's not really a lot of cracks to see here. Right now, at this very moment, there's no divergences in volatility. But I did want to illustrate how that can change quickly. So this is pre-volatility blow up in 2018. And you can see on January 3rd, you had a contango ratio of 0.74. It took about a whole month, but this one day, you got the VIX to VXV ratio to spike to 0.9. It then came back down to 0.82, but there's a big divergence there. And then just a few days later, like a week later, 2 weeks later, you're backwardated at 1.3. So yes, at the moment, the ratio of VIX to VXV is saying this is risk on, this is bullish, but this is how quickly things can change. So it's important, I think, to watch for an initial spike, some sort of pullback where price makes a new high, some sort of divergence, but we're not having any divergences at all yet. We're just printing new lows on the ratio of VIX to VXV. So that means the vol ETPs will continue to decay quite rapidly. And as long as there's a lot of steepness in the vol curve, that will incentivize sellers to bring that back in line. What you want to see is the flattening and the low level of volatility, and that will be the indication of complacency. That's all I had to share today.
Yeah, thanks, Robby. Very interesting point, and I like to monitor those things and vol ETPs all the time also. So yeah, what we were talking before the show is actually that so-called decay factor of vol ETPs, so mostly VXX, UVXY, and so on, is relatively high compared to historical values. So yeah, all things being equal, and we know that in the markets, all things are not being equal all the time, but all things being equal, those ETPs will continue to decay a lot, and it's harder to expect big spike in volatility happening very fast, like tomorrow or whatever. For those who are interested, I can elaborate further in the future on how to calculate decay factors. The thing called VX30, which is a constant maturity VIX future, which of course doesn't exist. So that's why every day you need to take M1 and M2 and weight it by time to get that value. But yeah, if someone wants in the future, I can talk about that. But yeah, very good points about correlations. I mean, I will not talk about correlations, nothing to talk about them. We all know the situation here. And also we know what markets are doing, and especially vol. But today I wanted to touch a bit on some vol numbers, just for us to for listeners to better understand where we are at from volatility perspective, and why it's not the time to chase the longs, especially if you don't have long positions. So it's not the time to open. So from all the vol indices I monitor, most interesting ones, basically VVIX is in the 30th percentile, which is historically low. Current value of 87.4 is like 32nd percentile from the period that I monitor. Then if you're familiar with nations indices, they are also very useful for those who are monitoring. So SDAX is in a 4th percentile. TDEX is in a 33rd percentile, which is of course normal when we're talking about tail side. But yeah, VolQ and Volley, basically you can think of VolQ as just another version of Nasdaq Volley, but basically VolQ is in 10th percentile and Volley index 22nd percentile. RVX is on a 41st percentile, and of course we saw the performance of IWM versus other major indices, so it's not hard to explain. So maybe from my watch list, if vol goes up a bit more, I would like it to be at 50th percentile or so. I will start looking at iron condors. For now, I'm not trading those. I will talk about my current book in the future, but in a few minutes, but of course, no surprise that almost nothing is in there. Yeah, so RVX is in a 41st percentile, which is nice. VXN 40th percentile, but basically what we have, VIX is only 22nd. So with this VIX, it's crazy. For those who follow bonds, so VXTLT 37 percentile, and actually VXTLT has with the level of 17 has a more than 3% premium over VIX. So like I believe Bryan was talking. So maybe in the future, there will be opportunities with bonds as well. But with those major ETFs, what I would like to do when vol is relatively not low, I would think about iron condors. Now from low volatility point of view, I'm looking to play long vol in things like QQQ and SPY. again, no trade, but with volatility this low, I'm looking at put calendar spreads. So most likely it would be like selling at the money or very close to the money August put and buying September with the expectation that volatility will go up and the spread between the two will also go up. But again, not a trade. So for those who have access to our trading view scripts and also correlation script is free for everyone. You don't even have to have a MFR account, so you can always check those. So yeah, correlations are relatively low. Bullish trends are very, very strong. The only good thing that Bryan also mentioned, yeah, that from long-term range perspective, not a lot of upside. Upside is quite capped. But yeah, why I just read a lot of random numbers about volatility, I just wanted to tell that in this vol environment, chasing, it's too late to chase. So we all were waiting for crash, and we are still, at least I am still waiting for that crash. But those numbers at least tell you one thing, that it's too late to chase stocks on alongside, at least for this moment. So yeah, my book, I missed last market talk. So basically what I did, I got rid entirely of 6C short. So I made a few percent, but basically now I'm not shorting the euro because momentum and overall short-term probabilities just show that it's not clear. So I was shorting 6C from like 110.50. I closed at entirely at 1.0790, I believe. Yeah, but yeah, so I don't have a short euro position for now. I added to September SPY puts, but those positions are very, very small. My entire SPY put position, so because it's long, so of course the risk is the premium you paid. So I paid like 1% of my NAV. So yeah, but September still, because of this low volatility, I added to those puts. So for basically one reason, and that reason is that based on our expectations. So and we are repeating the same thing on every talk. So expectations are, of course, that we expect, or at least I expect, market to still go down, because this bullishness is not, well, it's crazy in my opinion, what is going on. So yeah, so and volatility kept going down, so I bought more puts, but it's still a very, very small position. So yeah, so plan is to monitor volatility, especially on things like TLT, IWM, and QQQ, because I think SPY puts are enough, and thinking about iron condors or calendars, depending on what volatility is doing. So that's it from me now, because no new positions except those puts. In my smaller account, I'm still day trading futures almost every day, but it's scalping, never holding things overnight. So yeah, both on long side, short side, depending on order flow, but the average trade holding time is, I don't know, 1 minute, so nothing to talk about here. Okay, first I want to encourage that if you have any questions, there is a chat on YouTube here, so feel free to ask your questions, or if you have any comments, and we will do our best to answer them.
Hey, Vi, I also had a chart I forgot to show that I was meaning to show.
Sure,
If
awesome,
that's okay.
of course.
So this is the liquidity chart that I've often, I don't know if I've shown it on here, actually. I've shown a different version of this chart potentially. So this just shows a 50-day of the S&P 500 components. and it's taking a rank of the absolute price change divided by the dollar volume.
Okay, let's wait for Robby to come back.
It crashed again.
Yeah.
Okay, so yes, it's taking a 50-day rank of the absolute price change divided by dollar volume for all of the S&P 500 components. And it's the same story for the past, yesterday, for the past 2 months, basically. You're getting these tiny index moves and extremely illiquid readings. Typically, the extremely illiquid readings are followed by one-day bounces. You can kind of see that here, and like sort of here. But usually you're getting big downside moves, so it's still just extremely odd behavior. And in other cases, you're getting highly illiquid moves to the upside, like here and here. This was back in October on the 5% day. So it's just this strange illiquidity in the market, despite price going up and all these risk on, risk off spreads saying that it's risk on. Internally, the market is still extremely unstable. So I don't know when that will matter or if it will matter, because it doesn't seem to have mattered yet, but it's something I still am very wary about.
Yeah, for sure, it's something you can't ignore. But yeah, you're right. For now, market doesn't care about anything at all. Okay. Anyone wants to add anything before we start answering questions? Well, at least for now, we have one question. But... No. Okay. So yeah. So there is a question. Maybe it's for me or others want to add something, but yeah, it's related to sector correlations. So maybe Robby will have an opinion on that also. But in the middle of May, sector correlations were strong. Then the market moved higher with sector correlations weakening. Is that a sign of covering shorts, as the bear case demonstrated by correlation weakened? So, Robby, do you think it was shorts or no? I think it was a combination of a lot of different things.
Yeah, I'm not sure that you can necessarily attribute directional moves to correlation. It's pretty direction agnostic. As a general rule, when correlations are low, you're getting a drift higher. As a general rule, when correlations are really high, you're getting both large upside and downside moves. The other consideration is, is your measurement of correlation accurate? So if you're taking something like a 10-day correlation, you can't really be sure that whatever value you're calculating is representative of what the true correlation in the market is.
Yeah, I'm totally sure. True, especially with shorter term. That's why you need to look into a lot of different time frames to understand the overall situation. But yeah, my opinion that for short covering, you need to, or directional things, to at least try to understand what's going on. You need to use other things, not correlation, for sure. And now I'm just looking at average volume. Well, now I'm just looking into the most important ETFs, not the individual stocks, but average volume is nothing special. So I don't think that something crazy happened from short covering side, especially. Yeah, so feel free to ask any questions if you have maybe in the future we will try to do that on Twitter Spaces also. Yeah, but let's wait for a while. So
Hey, Vi,
yeah.
what do you think about Hearst being just the absolute lowest thing I've ever seen in my life?
Yeah, I noticed that as well. And basically, also it depends on which period of hers are you looking at,
3
because
months.
yeah. So because 1 year looks fine at least. So what we saw currently with this rally from basically when the SPX broke 4200, what we saw, the road to 4300 is just a couple of weeks, but basically market stayed in quite a range for quite a while. Of course, it grinded up slowly, but basically it was still a range trade. So now trends are not very strong from her perspective. That's what it means, and it's not hard to spot on SPX SPY or whatever, because the range before it broke 4200, well, it spent quite a lot of time there. But yeah, overall trend, how I think of it, is strong, because relatively strong, because it's far away from any other trend indicators I use. So, and of course, MFR trend. And for those who saw it on Trading Views, that I mean, it's quite far away on almost all those things that are going up there. Far away from the trend line. So in combination, trends are still intact, and they are not really weak. But from day-to-day perspective, yeah, market is trading in a range. Then it breaks that range. It goes up for a while, and then my bet is that from ranges and everything, yeah, my bet is that 4400 can be a top if we ever, not ever, if we reach it, that level during the move. But what I expect still, if we don't get a sell-off, I expect range to continue again. So that's how basically at some point markets will start ranging, or we will get a correction. But that's how I think about that situation. And actually, now when I look, yeah, what has the, okay, sorry. Yeah, SPY very low. I mean, 3-month Hurst of 5 of 56 is very interesting, and high Hurst assets are, yeah, of course, oil, USO, USO, and XLU. Actually, XLU is very interesting because I was monitoring all those spreads that involve the XLU, and another good indicator that markets are simply in risk on, nothing matters. And of course, one day most market participants will get a cold shower. At least that's what I expect. But for now, if you had to monitor one asset to see risk on, risk off, of course, VIX is one of those. But I mean, you can just monitor XLU, because Hearst is relatively high, and price action was also telling.
You gonna get into XLU IWM with me this time?
Yeah, I mean, I have it in my watch list. I still don't see entry point. Nope, but no way. Yeah, so we don't have any questions, I believe. Yeah, because yeah, you have a lot of questions when I'm not here, and now because I came back, no one wants to ask any questions. Okay. So I don't know. While we wait, you want to add anything? And if not, if we don't get any questions, I think we'll wrap it up. Actually, I think some users I'm sorry, not users, listeners complain that it's hard to watch very long talks, so maybe it will be even better if we keep it like 1 hour long.
Let's make a bet then and close it up.
Yeah. You have any ideas?
Yeah, let's do the price of VXX, not of VIX,
Yeah.
for the next market talk.
Okay. Yeah, I believe I need some calculator.
So it's 28.2 today.
Yeah, 28, 21 and closing price, yeah, after hours 28.17, doesn't matter. Yeah.
And the last 2 weeks, it's gone down 30%.
Yes.
41.6.
Cool.
I'm gonna go with 28 in 2 weeks. It'll be unchanged.
Man, Robby. That means it's got to go lower first, probably, right?
Yeah,
Yeah.
It's at 21.6. I'll write this in the chat. What do you say, Vi?
$27.
Well, I'm going to say like 23.5, pretty
Nice.
randomly. I'm going for the full smash volatility.
20. Wait, Robby, did you say 28.6 or 21.6?
I said 28,
Okay.
just unchanged.
Yeah, 20.
Andrea says 23.5, which means I'm in for more drawdown. What does Vi say?
27.
27. Oh, if no hope.
Yeah. Yeah, because 2 weeks, of course, is a long time, but yeah, like I said, at least for now, it's hard to expect a big wall spike in the upcoming couple of days. So in a very short term, of course, in 2 weeks, you haven't, but yeah, it's hard to expect a vol apocalypse during upcoming 2 weeks, especially, I mean, it's summer, not a lot of well, unless Fed does something, but yeah, not a lot of serious things going on, except I don't know, if nothing bad happens geopolitically, I don't expect a big vol spike. So.
They're all at the beach in Portugal.
Yeah, beach in Portugal, T-bills and beach in Portugal.
That is my month from now on.
Yeah.
And just for everyone's reference, on a 2-week period, VXX decays over the last 15 years an average of 2%.
Yeah, about right. Yeah, average daily is 0.2 something. Yeah, I measure that as well. Yeah.
So Vi's got a pretty solid number at 27 there.
Yeah, but well, actually, we have time. I don't know. Yeah. So before, but yeah, I calculated how I calculate the roll yield. So actually, current roll yield, if all things being equal for 1 day, of course, is yeah. I will tell. Actually, it is VX30. I will calculate now VX30. Okay. Yeah. So basically, roll yield is 16%. Yeah, 0.55% a day, which is historically high. I mean, it's this number is being calculated from VX30 and VIX difference. And VX30, yeah, basically you take M1 and M2. Because vol ETPs every day they roll from M1 to M2 based on the how much time left to the expiration of M1. So they always try to have this constant maturity 30-day VIX contract, which doesn't exist. So if it's a first day of M1, so let's say the current M1 started in May 20th or something like that. So let's say the first day when the roll happened, those ETPs rolled 100% of M1. Next day, they sell a bit of M1 and buy a bit of M2. So after a day, let's say approximately 95% M1 and 5% M2, whatever. And they do it every single day. So based on that, I calculate this VX30 number, which is currently 16.3. And then all things being equal, you can have a number, expected decay number, but of course you need to calculate it daily because it will change a lot. And of course this number matters only as with everything if all things being are equal. So yeah, so I just wanted to mention that the decay factor, which averages 0.2%, approximately, like Robby said, in 2 weeks, yeah, 2% something, but current daily decay is 0.5. So I don't expect that to continue for 2 weeks or so, but of course we'll see. Because if this situation with VX30 remains the same, and if market will be calm, again, if market is calm, so a lot of things must be equal, then you can expect that VXX will decay a lot more than 2%. But of course, it's just a talk based on number which is for a day on a daily basis and changes a lot, and VIX decay can only be predicted only if nothing else changes in the market. So yes. Yeah, last check. So we don't have any questions. Yeah, people don't want to ask us questions today. Okay, so I think let's wrap it up. I hope it was useful. And yeah, if you guys are interested more about volatility or anything else, also feel free to contact us on Twitter, ask questions, or do it during our live streams. So yeah, thanks Andrea, Robby, Bryan, thanks everyone for watching. I hope it was useful, and see you in 2 weeks. Bye.
Thanks, guys.
Thanks, guys. My pleasure.
Yeah, see you on a beach in Portugal.
That's the goal.
That's the goal. Yeah, okay, I think